Good morning, you magnificent melonheads. Today is Monday, March 27th, 2023. Top stories this morning. First Citizens Bank has entered into an agreement with the FDIC to buy the scraps left over from Silicon Valley Bank. This big deal was announced late last night, the details of which are just starting to come out. But let's just say this was a pretty sweetheart deal for First Citizens Bank, and their shares are reacting appropriately this morning. They are getting $16 billion discount on Silicon Valley's assets. Why? Because those assets are not really actually worth anywhere near the amount being advertised on them. That might be why they're getting such a big discount. They're also getting some free insurance from the FDIC. First Citizens Bank has just bought their way onto the protected list over at the FDIC. And on top of that, they are leaving $90 billion behind. That's going to remain sitting on the FDIC's balance sheet. Gee, I wonder if all of that commercial real estate crap, all of that toxic sludge asset might still be sitting on the taxpayers' books right now as they announce this deal to take over what's left of Silicon Valley Bank. And with that, we are going to shrink my big melon of a head and take a look at what's going on in markets this morning. We've got the S&P 500 is currently up 24 points or 0.61%. The market is green pretty much across the board this morning. We've got the Dow. This can't be right. We're going to have to refresh this. No, that's right. The Dow is up 39 points or 0.12% right now. Let me refresh this real quick here because this was up 230 points just a minute before the open. Now there it is. The Dow is up 39 points. I don't know what happened. We were up 230 points a minute before the open, and the NASDAQ is up 25 points. Big red candle gapping down at the open right now. So it looks like this optimism of this deal is very quickly wearing off. And look, the financial press was very quick to declare victory over the bank run this morning. We're going to get into some of the numbers that says that's not really the case, but let's move on. Right now, the U.S. dollar is at 103.03, down 9 basis points this morning or 0.08%, kind of trading range bound. And looking at the bond market, we've got yields are rising sharply right now. This is bond prices heading lower. So we've got a sell-off in bonds and we've got people buying stocks. So this looks like risk on this morning. The biggest mover in the bond market is the 3-year yield, up 18.5 basis points to 3.77. And the all-important 10-year is at 3.498, up 12 basis points this morning at 3.55. Looking over in the commodities board, we have got a little bit of a price smash going on in gold right now at $1,969, down 32.5 bucks this morning, or 1.65%. Silver is down about a quarter, or 26 cents, at minus 1.1% for the morning at 23.08. Over on the energy side, we've got crude oil. WTI is back over $70 at 70.39 this morning, up $1.13, or 1.63%. And natural gas getting slammed again, down 11.5 cents or 4.83%, sitting at $2.24 this morning. All right, let's get into some of the news from this weekend. We had that big meeting, the FSOC, which is the Financial Stability Oversight Council. That is the federal government's OMG, the sky is falling organization that only gets together when the financial system is super strong, right? Well, they had their emergency meeting Friday afternoon. All the biggest wigs in finance and insurance and banking, they were all there. And after that big meeting, they released a statement that said the banking system was sound. Wow. So, I heard that meeting and I was like, I'm so glad you're here to tell us these things. Chewy, take the professor in the back and plug her into the hyperdrive, will you? Because, look, how much payroll was in that meeting? What did that meeting cost the taxpayers between the number of people that went in there, their hourly rate, all of their aides and researchers that went in there with them, all to release a statement that said the banking system was strong? Okay. Tell me you got nothing done at that meeting without actually telling me. So literally nothing happened at this FSOC meeting, which I'm just amazed that the market isn't selling off high big time on this news, because where we left off Friday, the financial contagion was spreading into Europe and Deutsche Bank. Well, that appears to, at least at the moment, to have abated a little bit, but right now, I couldn't tell you, folks. But look it over here. Check this one out. First Citizens buys Silicon Valley Bank after the run on the lender. And it's the details of this deal that should, I don't know if worry you is the right word, But this is a mess, folks. This deal is a freaking mess. It's a sweet deal for First Citizens. It's a lousy deal for the American taxpayer. And, well, just look at this. The lender assumes $56 billion of deposits. So not Silicon Valley, First Citizens Bank now owes an additional $56 billion to the depositors of Silicon Valley Bank. But in exchange for that, they're getting $72 billion worth of loans and assets. So right away, at least on the surface, if we take these numbers at face value, which is a leap of faith, Silicon Valley Bank, or First Citizens Bank, is getting $16 billion in this deal because they're getting $16 billion more in assets than they're taking on in deposits. But that's not really the case because they can't sell that $72 billion in loans and assets. They'll never get $72 billion for it. So it looks like such a sweet deal, but the devil is in the details. Oh, and by the way, this deal is going to cost the FDIC an estimated $20 billion. That is a full 15% of all of the money in the deposit insurance fund over at the FDIC. So 15% of the cushion at the FDIC is now gone just on Silicon Valley Bank. So the FDIC is pretty much betting the farm here that they're able to stop this run right here and now. Want to show you a little bit more of the details here. The bank has agreed to take on all deposits and loans, a deal that includes the purchase of about $72 billion of SVB's assets at a discount of $16.5 billion. According to a statement from the FDIC, the agency took control of the bank after SVB collapsed. But this is an important detail here. About $90 billion in securities and other assets will remain in the receivership for disposition by the FDIC, while the federal institution also got equity appreciation rights in First Citizens worth as much as $500 million. So $90 billion of securities and other assets will remain in receivership at the FDIC. Why do you think that is? Why do you think First Citizens Bank is refusing to buy $90 billion of securities and assets that are going to stay on the books at the FDIC? In other words, the taxpayers are still on the hook for that stuff. Do you think it has anything to do with the fact that that $90 billion in assets isn't worth anywhere near $90 billion? That this is commercial real estate or CMBS or mortgage-backed securities that they don't want to touch, that they don't want to increase their exposure to, and so the taxpayers are going to sit on it. In other words, the FDIC is propping up the value of these things by avoiding them being sold in the open market. The taxpayers are absolutely going to be footing the bill for this bailout. But there's some very important details in this that I want to get here. Look, shout out to, I can't remember the name. Somebody posted this in the Discord last night. Oh, I apologize. Mish was all over this. Mish, let us know in the chat who it was that said that in the Discord. But I had to go all the way to streetinsider.com to get this detail because Bloomberg and CNBC are not covering this little aspect of the deal. But I got to zoom in on here. As part of the agreement, First Citizens Bank will assume Silicon Valley's bridge bank assets of $110 billion, deposits of $56 billion, and loans of $72 billion, based on the latest information provided by the FDIC. First Citizens Bank will additionally receive a line of credit from the FDIC for contingent liquidity purposes. So they're getting a free line of credit from the FDIC. In other words, hey, if you take on all these toxic assets and they go down in value and your bank starts to fail, we got your back. In addition, First Citizens Bank has entered into a loss share agreement with the FDIC to provide further downside protection against credit losses. So the FDIC has agreed we will backstop First Citizens Bank in exchange for this deal. What a sweet deal for First Citizens. They get a $16.5 billion discount on these assets and they get free insurance from the FDIC. First Citizens Bank just bought their way into the boys club. They are now in line to get bailed out. They are the have banks. So there's no need, if you're one of the depositors looking to yank your money out of the small banks and go to the big bank for safety, well, First Citizens Bank is now one of those safety places where the FDIC will have your back. Amazing how that works. Now check out what's going on in the press this morning. This is in CNBC, and I just love how they do this. Deposit drain from smaller banks into financial giants like JP Morgan Chase has slowed, sources say. What sources? Nobody knows because nobody cites their sources anymore. The surge of deposits moving from smaller banks to big institutions, including JP Morgan Chase and Wells Fargo, has slowed to a trickle in recent days, CNBC has learned. How did CNBC learn it? Nobody knows because nobody will put their name to that quote. Isn't that funny? Now, this is what's interesting. The deposit drain, which roiled markets globally and forced regulators to intervene to protect bank customers, began improving around March 16th. Who said that? People with knowledge of inflows at top banks. Again, nobody will announce their own name. Nobody will put their name to this. Nobody will be quoted. Maybe it's because this is total horse manure. And look at that date, March 16th. That's also all very specific. Why do you think that is? Well, you have to go over to this article at the Financial Times, and it starts to make sense why they're saying as of March 16th, why these anonymously sourced people will say it slowed to a trickle. Now, this article is all about how money market funds are swelling at the big banks because people are pulling their deposits from the small banks, putting them into the big banks, or they're pulling their deposits and putting them into money market funds, which are backstopped by the FDIC. Now, in this article, they have mentioned, I had it highlighted and I lost it. We're going to find it. Here we go. Federal Reserve data released on Friday showed bank deposits declined in the week through March 15th from $17.6 trillion to $17.5 trillion, and deposits at small banks declined from $5.6 trillion to $5.4. You see, according to any publicly available data, as of March 15th, the run on the banks was still going strong. And here is the Fed's data to support it. This shows deposits at all commercial banks. And look at this drop here. Folks, this is the run on the banks happening, gaining steam. You'll notice, by the way, it started in 2022 with the rate hike schedule, but man, did it pick up steam in these last few weeks. And again, as of March 15th, this thing was steepening, not getting better. Now check out small banks. Oh, okay, look at this one. Look at the data point on March 15th. That shows the deposit outflows from small banks from a high of $5.6 trillion all the way down to $5.4 trillion. Now, according to this anonymous source in this CNBC, which is known for writing puff pieces about bank regulators and for parroting how strong the financial system, they're saying conveniently that a day after this god-awful data was released, that the outflows from these small banks slowed to a trickle, and nobody will put their name to that quote. In other words, the financial press, CNBC, is out there right now declaring victory over this bank run, citing this buyout of First Citizens Bank, which is a lousy deal for the taxpayers at best. And nobody is willing to put their name to this quote about how the deposits at the small banks have slowed to a trickle, even though the most recently available data, which is up to the day before they're announcing this trickle happened, showed that it was a deluge and not a trickle. So that's why I say the press is very quick to declare victory on this bank run, because the financial press is part of this cabal of bankers and regulators that just wants to sit there and repeat day in and day out how strong our financial system is. And folks, that is the top stories this morning. I just want to say thank you very much to all my Patreon supporters, everything you guys do for the channel. And thank you. Who was it? Oh, I'm so sorry. I can't remember the name of the person who found that story about the backstopping of the FDIC. I just can't remember the name off the top of my head. I'm a little off my game this morning, folks. But thank you guys very much. Link down below to the Patreon should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.